India on Friday announced its sixth and final bi-monthly monetary policy review for the current financial year. And this was also the first policy review after the Union Budget for financial year 2026-2027, presented by Finance Minister Nirmala Sitharaman. Addressing the media, RBI Governor Sanjay Malhotra said that the Monetary Policy Committee has decided to keep the repo rate unchanged at 5.25% and maintain a neutral stance. Well, this decision ensures that borrowing costs remain stable, existing EMIs will not rise, and fresh loans will not become costlier. Well, the RBI's move signals a cautious wait-and-watch approach amid evolving economic conditions. Well, why did RBI pause rate cuts? Notably, the pause comes despite retail inflation staying below the 2% lower tolerance band for the last 4 months. And the government mandates that the RBI to maintain CPI-based inflation at 4%, with a margin of 2% on either of the side. Well, Governor Malhotra explained that while inflation is currently subdued, the central bank prefers to remain cautious and gather more data before making further changes. And the neutral stance allows the RBI to respond quickly if economic conditions shift, balancing the need for growth with price stability. Now let us shed light on positive growth outlook. The RBI expressed confidence in India's economic trajectory, revising GDP growth projections upward. And the economy is expected to grow 6.9% in Q1 financial year 27 and 7% in Q2. The central bank also highlighted that GST reforms, supportive fiscal measures in the Union Budget, easing monetary conditions and low inflation are expected to boost private consumption. Additionally, ongoing trade agreements are likely to strengthen exports, further supporting overall economic activity. Well, what has been the inflation outlook? Notably, on the inflation front, the RBI slightly raised its retail inflation forecast for financial year 2026 from 2% to 2.1%. And CPI inflation is projected at 4% in Q1 and 4.2% in Q2 financial year 2027. Governor Malhotra noted that inflationary pressures remain muted across most of the sectors, except for precious metals like gold and silver, which are impacted by global price fluctuations. And the prices of other commodities remain stable. Well, the RBI will present a full-year inflation forecast in its April policy review once more data becomes available. Well, there are certain consumer protection measures. Notably, the RBI announced a new framework to compensate customers up to Rs 25,000 for losses from small-value digital frauds. And Governor Malhotra said that the RBI will release a discussion paper in order to enhance digital payment security, including additional authentication layers, better credit limit controls, and safeguards for senior citizens who are often most vulnerable. Well, what are the measures that are required to support credit and businesses? In order to strengthen credit flow, the RBI doubled the collateral-free loan limit for MSMEs to Rs 20 lakh, allowed banks to lend to real estate investment trust, and relaxed branch opening norms for certain NBFCs. And all these measures, combined with fiscal support in the Union Budget, aim to boost private investment and economic growth. Well, what has been the repo rate recap and its significance? Notably, in 2025, the RBI cut the repo rate 4 times, reducing it by a total of 1.25 percentage points, from 6.5% to the current 5.25%. And the repo rate, which is the rate at which the RBI lends to banks, influences loan rates for consumers, and lower rates make borrowing cheaper, while higher rates help control inflation. Well, what can we look ahead? The Monetary Policy Committee, comprising 6 members, 3 from the RBI and 3 appointed by the government, meets every 2 months, and the next meeting is scheduled for April 6 to 8, 2026. And until then, the RBI will closely monitor inflation, growth, and global developments in order to ensure a balance between price stability and economic expansion. That's all for now. Stay tuned to the Savera for more updates. Do like, comment, and subscribe to the channel.